Hey, are you new to investing, but you want to make sure you avoid the common mistakes that plague most beginner investors? Well, this video is for you. Today, we're going to discuss common mistakes that investors make when they're beginning and how to avoid them. Welcome to the Wealth Twins Show. Nicole, set it off with mistake number one.
All right, mistake number one, investing like it's a one size fits all thing. You cannot be investing like what works for someone else would definitely work for you because that's just not the case. All right, for example, I believe someone in their 20s has a different risk tolerance and different goals than someone in their 40s who may be married, may have children, and other financial responsibilities. Those two people should not be investing in the same way. All right. Now, on top of this, the age difference and the financial responsibility differences, you have different trading styles. A person that's interested in building wealth on like a long-term basis should not be investing in the same things as someone who's doing like say trading options or trying to do swing trading or day trading. Those are two different trading strategies and it will lead to two different types of like investing styles. So with that, you cannot invest like what works for someone else will definitely work for you. And I think a lot of people overlook that and it ends up hurting them in the long run.
Yeah, I would agree. I think when people start investing, they ignore three major factors. One factor is your goals, another factor is your timeline, and another factor is your risk tolerance. If I'm in my 40s and beyond, I will not have the same timeline when it comes to investing as someone in their 20s. I also will not have the same goals, and I also will not have the same risk tolerance, specifically because I don't have the same amount of time in the market to recover from taking on riskier strategies, right? So investing is not a one size fits all. You can't just be taking hot tips for someone and expecting they're going to work out for you. And if you come up with a conclusion that this is not for me, maybe it's because you didn't sit back and understand, hey, maybe the way I want to invest should not be the same as someone who has less financial responsibilities as me and different risk tolerances. Okay. So how would they
So
avoid it?
basically, the way to avoid it is just basically what you were saying. You need to understand three of the biggest main factors when it comes to learning how to invest, and especially when it comes to buying your investments. You need to understand your risk tolerance, your timeline, and what are your financial goals when it comes to and how will you use investing. If you understand those three things before you actually start buying investments, it will definitely help you at least minimize that mistake of trying to invest like investing is a one size fits all. So with that, Nadia, let's get into mistake number two. What is an investment mistake beginners make that they should know about and try to avoid?
When I think about this mistake, I think about people who are only investing in their 401ks, and they may not be beginners, but it happens to a lot of people. When you're switching jobs and you're not making sure that your contributions to your next job retirement plan is one, actually happening, or two, is actually at the percentage that you should be investing in, right? And I'll go
Mm-hmm.
into more detail about this. So there was a study from Vanguard that said one out of four people, when they switch jobs, does not invest in their new job's retirement plans. That's because there's no automatic enrollment at these companies. So, say you were investing in your previous job's 401k and you were getting a match or whatever, but then you move to a new job where you're getting paid more. But guess what? You're not investing that money. So, you're just living and you're making the new money at the job, but you're not investing anything in the new job's retirement plan because they didn't put you in it automatically. Another mistake that comes with that, let's say your job does have an automatic enrollment when you move to that new job. Now you're getting paid more money, but that automatic enrollment is at a lower percentage than what you were actually putting in your previous job. So you're not looking at it. You just say, oh, I have a new 401k or a new 403b, whatever you have in your new job. And you say, oh, I'm automatically investing. But it's probably lower than what you were doing at your previous employer. And you're missing out on thousands of dollars in the long run because you're not investing as much as you were before. In addition to that, you're probably getting paid more at that new job. So you have the potential to actually up the percentage of the money that you're putting in your 401k or just retirement plans in general, but you don't make that change. You're still living at the same way that you were, or investing in the same way you were at your previous job. You only had a lower paycheck or a lower salary, and now you're not making up that difference.
I would go into it's not just switching jobs. Say you get a raise, right?
Mm.
If you're making more money and you're not taking the next step as to actually taking some of that extra money and putting it towards your retirement, you're making a mistake. Now, when it comes to someone switching jobs, I can understand at the beginning because you're in a new job. It's exciting. It can be overwhelming. And you're just trying to actually get your bearings of where you're going to be and actually learn your new position. So it's definitely something that people may just, leave off the table or forget about. But you have to remember, you have to think not just in the present, you have to think, how can I take care of myself in the future as well? So if you just keep this in the back of your mind and says, okay, I know this is a mistake that people often make, but if I get a new job, the first thing I need to do, if I'm not automatically enrolled, I should definitely go to HR when I'm filling out all my documents to actually make sure I'm invested in my job's retirement account and actually upping that percentage more than what I was doing in my previous employment. Two, if you're making more money, I want you to avoid lifestyle creep. And that's even when it comes to you switching jobs. You have to avoid lifestyle creep because one of the biggest issues that people have is when they have more money, they tend to spend more. But if you do that, you will always be on a treadmill or the hamster wheel, as we call it. Okay. So the way to stop getting on that treadmill, actually make some forward momentum, is to pretend like you didn't really get that big of an increase when it came to your salary. And then that increase that you did get, split it up among not just your savings for like emergencies and also immediate savings for different needs, but also put some extra towards your retirement.
Yeah, I will add also that you should at least be contributing the match amount, right? At least contribute the percent that you can put in so that your company does a match if your company has a match. And that's how you avoid this problem.
Mm-hmm.
So Nicole,
Mm-hmm.
what's another common mistake that plagues investors when they're starting beginning investing?
Oh, this is a good one. And everyone, I mean, even we're susceptible to this every once in a while, right? It's called emotional investing.
I
Okay.
agree.
And I'm not talking just when it comes to buying, I'm also talking about when it comes to selling. So buying and selling, being emotional. So Nadia mentioned before, she's talking about, you get a hot tip and you decide, I'm going to buy this. Well, that hot tip might not even come from your friends or family. It might be just you're constantly hearing the name on TV, like Nvidia. Everybody wants to talk about Nvidia and they feel like they're missing out because this stock is just going going through the roof. But guess what? If you buy based on just the emotions of I'm going to miss out, you're having FOMO, you might end up doing yourself a disservice. I would say I don't think I got one good stock tip that actually worked out where I was emotional about it without really doing my research and actually bought it just because there was so much hype about it. I don't think I actually made money off of it. And when it comes to selling, it's the same thing. When the market is going down and you're like, oh my gosh, I'm losing all my money. And then you decide to sell without actually thinking about, hey, is the market going down truly a bad thing for me? But instead, you're thinking about emotions and what you're doing at that moment. You're making a big mistake that can end up hurting you much longer down the line.
No, I would agree with that. And I will also say any tip that I ever got to buy something that was supposedly hot, I always lost money on it. And I learned stop doing it. And I still catch myself I'm like, oh, nope, not doing it, right? So a way you can avoid doing this and a way you can avoid emotional investing in general is to look at the stock market over a long-term period. If you look at the ups and downs on a daily basis, you're going to scare yourself and you're going to feel like you're on a roller coaster. If you want to stop emotional buying, one, stop taking hot tips for people without doing your own research. And two, make sure you're in it for the long term and not worried about what's happening day to day. If you look at day to day, you're going to see ups and downs, ups and downs. You're going to be like, why am I in this? This is so crazy. If you look at it the long term, it actually over the average has returned at least 7 to 8% return on your investment. So look at it from the long term and a wider view rather than looking at it day by day, and you'll be less susceptible to emotional investing.
Yeah, not just that, it goes with selling as well. Don't let your emotions force you to sell, okay?
Mm-hmm.
Because the only way to really lose money in the market, this is all like it's just numbers on the spreadsheet until you actually take your investment out and actually sell your securities.
Yep.
When you do, you're going to actually realize a loss. And the only way to avoid that is to understand, and the way Nadia and I think is that when stocks go down or when the stock market goes down, you can see it as a buying opportunity. I realize like it's the only place really that people see things go down in price and they feel it's a bad thing. If you were in a department store like Macy's or so, and you saw everything on sale, would you go, oh my gosh, I'm not going to buy this shirt. That's a great shirt because the price is lower. I want to buy it when the price is as high as possible. You don't think like that. So why is it that we think like that when it comes to buying investments? That's something you have to try to change your mindset and understand and say, okay, I can see this might be a negative thing, or I could take this as a way that I can actually get into the market
I agree.
and get more for the money I'm actually putting into the market.
Yeah.
And then you got to be willing to hold it.
And if you do dollar cost averaging, it works itself out over the long term anyway. So the ups and downs, you're buying more when the price is lower and you're buying less when the price is high. But at the end of the day, it averages itself out. Now, these three mistakes is something that we see common across investors, whether they're beginners or the intermediate investors. And because of that, if you found these three common mistakes helpful in understanding and understanding how to avoid them, then you will love what we share on our newsletter. It's free and we call it the Wealth Pack. If you want to sign up, you can go into the description below and find a link there. It's free for you to sign up, and we give more detailed information about subjects like this and plus more.
Yes, and if you like what we're doing here, we would love for you to support the channel. Share this with someone you care about, give us a like, and also make sure you subscribe and hit that notification bell because we're making videos like this on a regular basis, and we would love for you to come back and see us again. So with that, we'll talk to you next time, and we'll see you in the next video.
See you in the next video.